What happens when the cost of making everything from cars to coffee suddenly jumps up 4 times than the expected pace? Hi there, welcome to ShareTreck where science meets investments, and I'm your host Raj. Friends, by the end of this video, you would know exactly why today's Producer Price Index or PPI is shaking markets and what it means for Federal Reserve's next moves and which sectors could get hit the hardest or which ones would benefit. We'll look at the stock, bond and currency moves, unpack the Fed's likely response and end with enough information to plan our next moves. The July PPI came in hot, up 0.9% month over month, 4 times higher than Wall Street's expectations of 0.2%. Even the core PPI, which strips out volatile food and energy, matched that 0.9% jump. It means that this is not just a blip, it's a broad-based inflation pressure across the economy. On a year-over-year basis, producer prices are also running well above expectations. The question is, why does this matter? Well, PPI measures what producers are charging before the goods even hit the shelves. If their costs are rising sharply, there's a good chance they will pass those costs to the consumers. And that's when CPI, the inflation metric everyone watches, starts to climb, which means that PPI is a precursor to CPI. So the recent CPI report that we saw still does not include what is being seen in the PPI this morning. In reaction, rate-sensitive stocks took the first hit. Tech, REITs and home builders all sold off. This is because higher inflation means interest rate cuts are less likely, and those sectors that depend on cheap financing to drive growth were the ones to suffer the most. Bond yields shot across the curve. Higher yields mean new bonds will pay more interest, so the value of existing bonds dropped. Also recently, I think on the 7th of August or something, the 30-year bonds were auctioned. I believe it was $25 billion worth, and it did not go very well. And the yields were quite high on that as well. So all of these indicate a little bit of weakness. The dollar strengthened against major currencies. Traders expect higher US yields compared to the rest of the world, making the dollar more attractive. Wall Street had been pricing in September rate cut. This PPI report just blew that story apart. The Federal Reserve is laser focused on inflation control. With producers' prices spiking like this, they are less likely to cut rates in the near term, in my opinion. Cutting now would risk fueling inflation further, exactly what they are trying to avoid. They have a dual mandate. They have to look not only at inflation, but also at employment. In fact, the tone from the Fed could turn more hawkish in the upcoming speeches. They will prioritize cooling inflation over supporting growth, even if that means keeping rates higher for longer. Remember, in the last stagflation, when there was a contest between inflation and unemployment, the Fed had to finally use higher rates for longer in order to tame the stagflation. So I think at this point of time, the Fed has got an all clear to keep the rates as it is for a longer period of time. Well, friends, let us look at the chart out here. First, let me start with giving you an idea of what I think are the likely outcome for each of the sectors. If you look at tech and rate majors, they will face selling pressure because they are very rate sensitive. Home builders also may face problems because mortgage rates will go up. People qualifying for mortgages may reduce in number, and even those who qualify may think twice before taking the mortgage. So new home demand is likely to go down. And if you look at the banks, I think they would benefit because they would have wider lending margin. When it comes to utilities and bonds, I think utilities will not be that attractive when compared to bonds. Utilities are yield proxies, so investors buy them for steady dividends, typically 3 to 5%. When bond yields spike, like after hot PPI data, 10-year treasuries might yield 4 to 5%. Suddenly, risk-free bonds offer similar or better yields than utility stocks. So the investor generally thinks, why take equity risk for utility dividends when bonds can pay the same? So utilities also have another problem. They have massive debt loads. Higher rates increase their borrowing costs. So that's the reason why you will find that utilities will fare worse as compared to bonds. Bond prices move inverse to yields. So when yields rise, bond prices fall. Existing bonds paying 3 to 4% become worthless when new bonds pay 5%. Then we also have the duration risk. Longer term bonds fall harder than the shorter term ones. And if you were to look at insurance and defense, I think we have a winner out here. Higher rate means higher investment income on insurance companies, massive cash reserves where the companies invest their premiums in bonds. Better yields boost the profit, and the float income increases. That is the profit they make between collecting premiums and paying claims. That component increases. And when it comes to defense, I think it is more inflation proof because their demand is non-cyclical. Government defense spending does not fluctuate with economic cycles. Steady cash flows from long-term government contracts perform the role of inflation hedge, because defense contractors also have cost plus pricing in volatile or uncertain times, and they continue to get the same money that it was committed, and any cost increase is passed on to the government. So investors rotate into safe sectors with predictable earnings, and they may end up getting into insurance and into the defense sector. So when inflation fears rise, investors flee rate sensitive sectors like utilities and move into sectors that benefit from higher rates like insurance, or sectors that provide stability like defense during market turbulence. It's essentially a risk off within risk on move, staying in stocks but picking sectors that work better in a higher rate environment. Jobless claims fell modestly, staying low near the historical lows, and that tells us that despite inflation shocks, the labor market is still resilient for now, which means that we are not exactly into stagflation. Just like pre-diabetes, we may be into pre-stagflation, and the Fed has to play its card right. That means the Fed can still focus on containing inflation by not cutting rates. If the Fed keeps rates elevated into 2026 and inflation doesn't come down, that could change. But in the intermediate term, there is no sign of a jobs collapse. That gives the Fed more leeway to stay hawkish, in my opinion. So we'll have to watch out for what happens at the Jackson Hole Symposium, because we'll hear messages from there, and I suspect they are going to be hawkish. When you have a hawkish Fed, then the stock markets are likely to start declining. That's what I'm thinking, and I would like to hear from you guys. What is your analysis? Please put that in the comment section, even if you disagree with what I have said. Risk has just gone up. The calm inflation narrative, along with the government rhetoric that tariffs will not cause inflation, has pushed markets much higher earlier this year. That same narrative is now coming into question with these PPI numbers. I think going forward, the buy the dip reflex could be dangerous, and I think that the Fed cuts are most probably off the table in the near term. With that assumption, I think that being overweight on rate-sensitive sectors is a risky bet. Instead, one could consider balancing with defensive names like select insurers, aerospace, or defense, or short-term cash and money market funds. The next CPI release is the critical data point. If consumer prices spike alongside producer prices, expect more market downside, and one should also look out for potentially hawkish Fed commentary when they meet next at Jackson Hole. Friends, I think that today's PPI report is a wake-up call and is in line with my recent bearish bias. Inflation may not be as tame as markets once thought. As a retail investor, we need to stay vigilant, stay diversified, and we should not chase short-term rallies without checking the inflation backdrop. And if we do chase such rallies, then we should have stop losses and we should have some calls in place or some kind of insurance. That is my opinion. What do you guys think? Is this the start of another inflation wave? Please drop your thoughts in the comments. Folks, this is very important. If you found this breakdown helpful, please hit the like button to help YouTube reach this video to other viewers like yourselves, so that we can build our community of retail investors out here. Thanks for watching this video. If you are not yet subscribed, can you please subscribe and help us grow this channel? That brings me to an end of this video. Thanks and have a great day, my friends. Bye for now.